is calling. Gas trades are falling.
Hey all, it's Sunday afternoon, waiting for the markets to open a little bit later on. And of course, we're all watching natural gas. Now, we've finally got the COT report on the current positions, and you'll be pleased to see, if you're long on natural gas, that the hedges and the sort of commercials, swap dealers, have added a little bit more to the short side and less to the long side. We'll have a look at the chart shortly. And producers have gone a little bit more short as well, and the managed money also a little bit more short. So everyone kind of leaning short, but it's the hedges that we need to watch, and they'll be hedging to the short side because they think the market might be going up. Let's have a look at those on the charts and see where we are. So the red line, which is the commercials and the hedges, just ticking down a wee bit. This report came out on the 25th, so it's just a few days old. And then the green line at the bottom, the speculators and the hedge funds, just ticking up a little bit. So overall, kind of looks like the market's moving slightly to the long side. But let's have a look at the charts. So here's the natural gas 4-hour chart on the spot price here at Pepperstone. And this chart at the top right is the daily chart at the Henry Hub. We'll have a look at that briefly just now. So I've just switched back to the monthly chart here at Pepperstone. I want to show you something that's a little interesting, I suppose, and perhaps a bit of a guideline for you. I've got 3 levels drawn in here. They're of equal size. And you can see they roughly coincide with the general trading ranges that we've been in for the last 10 years. So you can see we've got a block from 1.88 up to 2.5. And then 2.5 up to about 3.25, and then 3.25 up to about 4.3. These ranges coincide with what sort of the price does generally over the last 10 years, and you can see we're right at the bottom of the middle range. So we're not in the cheap zone right now. You'll know that I've looked at this in different ways over the last period, looking at basement and bargain basement prices, the $2 level, below $2 and so on. But this is a more general picture. So we're right at the bottom of this sort of mid-zone here at about 2.5. So that's just a thought to consider, bearing in mind that we've seen that the COT report shows that we may be moving into a more bullish sort of phase of the market. And we are at the bottom of the mid-range of the overall market range for the last 10 years. Kind of something like that. Let's switch it to a weekly chart to zoom in a little bit. And you can see we're at the bottom of that range, and now I've drawn a Fibonacci in here. We need to go to the daily chart to have a look at more detail. So here's the daily chart. We're at the 78.6% Fibonacci from this last swing up from the low to the high. We've got the 200 and the 50 period simple moving averages just below here at about 2.4, and they're actually in confluence together. They're touching each other, forming an even more powerful support. We've also got a little gap here that we may have to close, and that would actually take us down to those 2 moving averages. Let's have a look at the 4-hour chart, and you can see quite clearly there's the 786% fib. We've got down through all the 4-hour moving averages, so in the short term we've turned a bit bearish, but we are at support and we are at the bottom of that long-term sort of buying range. And the futures market through the COT report seems to be indicating a move to a more potentially more bullish phase. I want to look at this on the Henry Hub futures chart, and there we are there. If you remember, we rolled over into the new contract just a couple of days ago on Wednesday. So we're now in the August contract. It's interesting on this daily chart, we've got what looks like a head and shoulders pattern formation, or a Christmas tree, almost that sort of shape. Head and shoulders with the left-hand shoulder here, potential right-hand shoulder there, and a break below where we are now at about 2.6. This is the futures. We're at 2.5 on the spot, and particularly a break down below 2.45, 2.47 where these moving averages are, and the swing low could actually force this price quite a lot lower. We could end up actually visiting 2.1 where the 100 period moving average is, or even back down to this gap here below $2. I don't think that's the most likely scenario, having looked at the COT report and seeing the way this is playing out. And if we switch back to the 4-hour chart on the spot price, which is what most traders will be trading, that's where we are today. Now, the weekend rollover gap is coming up. I'm not saying it will gap, but it probably will. It does most weekends. I'm hoping that this will gap up. And the last closing candle on Friday was this inverse hammer, inverse hanging man sort of candle, which is actually a bullish reversal candle. And if we do gap up over the weekend and sort of carry on moving up from there, that would confirm this and make this a particularly good reversal candle indeed. I'm hoping that's what will happen. Could be that we just gap down, clear out some paper hands, pick up a little bit more liquidity, and then surge on higher. I'm hoping for a gap up rather than down. I'm looking forward to it. I'll see you later on.
Henry Hub is calling. Gas trades are falling. In this game, gotta be all in. You win or you sin. Natural gas blues, what am I to choose? All this gain I could lose, feeling that Louisiana groove. Charts and ticks on my screen.